what we want to look at today is kind of wrap things up, and it'll go through the monitoring the portfolio, the investments, and the estate planning, right? We teased you a little bit the first day about what investments you can utilize. I wouldn't use anything other than mutual funds or exchange traded funds or T-bills or CDs. I wouldn't mess around with come to the steak dinner. Is this a great deal? And we're buying real estate up and all these things. I want the investments to be regulated and listed on the exchange. And granted, there might be more profit for you to be a venture capitalist, but there's more risk, right? We would rather have investments that have ups and downs in popularity in the market, but they represent a portfolio of several different funds, and each fund represents a basket of stocks or bonds or both. And then you can do some history, and we showed you some things about how to look at a fund and what to look at, but it's also listed in the book. While I'm on that topic, this is something called broker check, little flyer that Shaniqua has over there you can take. And if you have an advisor or an advisor is contacting you, you always want to run their background check. And you want to know what they're about, what licenses they have, what education they have. We have some of them over there. And that broker check will tell you everything. I had to update mine, and it actually had how much I weighed. It was like, what is this? Every year we have to do an attestation and say yes, no, and I do this and I understand. And on there we had to update something, and it was that. So this, if you ever have a question, or if you have a friend saying, yeah, this guy or gal's calling me wanting me to do this, if they're a licensed broker or advisor, I would check their background out. We have found some of them where they were trying to get one of our clients, but we looked it up, and the guy had a misdemeanor assault charge. But we know that misdemeanors usually come from felonies that get pled down, right? Or one of them stole things and got caught stealing something, or one of them didn't pay their It was just unbelievable. And unless it's related to securities or investing in it with a client, they can still work in the business, but it has to be disclosed. So the broker check for you or anybody else, we already talked about Renaissance, but there's the information there. And if you have anybody else that says, I want to be an advisor, or I want to invest my own money, or I don't want to invest my money, then try to get them to at least look at the website or consider the class. This little thing is a magnet, and it just tells you, and it's not for you because you guys are pretty sharp, but if you have any friends that you're worried about them being taken advantage of by fraud or cyber stuff, grab one of these that are over there, give it to mom or somebody else that you want them to review it, and just be aware of what's out there. And then you already, this is a glossary of terms, right? Okay, yeah, and you can get them at the back of the book, but it's kind of nice to see what this is, because everything that we're doing, you could do if you focused in on that area, but it's just a lot of things. It's like looking at plans for a building. Oh, I've got this one page. I can figure out, there's the walls. No, wait, here's the energy calculations, here's the electrical, here's the this, and it just gets to you. It could be too much. Okay, so once a person has looked through your cash reserves and paired off any expenses, and I do that online, or your credit card, because there's a lot of things they bill you with. We don't turn it off. Maybe we forgot, and they're charging us $5-10 a month or something. You net your expenses out, fine. Or let's say you just paid off your mortgage and I got an extra $1,000 a month. What do I do with it? I think it would be cool to take that $1,000 and shift that into a total stock market index fund. And it's going to be up and it's going to be down, right? If you're in the S&P 500 or the Dow or the total stock market. Now, what's the difference? The Dow represents 30 stocks. The S&P represents 500. The total stock market index probably represents about 1,500. That meaning it includes smaller stocks, medium, and large. Because the S&P 500 just wants the 500 biggest stocks. But the total stock market has mid-size and small size. Now, they're going to have a little more volatility in and of themselves, but they haven't grown as big. And if interest rates come down and a lot of money comes to this country, the small and mid-sized stocks might stand to benefit from that. Who knows? But the total market index is a bigger group of stocks versus the S&P or the Dow 30. So if you are paying off your house, say, what do I do with this $1,000? Put it away for yourself in late retirement, buy a little bit each month, because the more frequently you buy, the less emotional upset you have. Because if you bought it at 10 and it drops to 5, buy it again at 5, your average is 750. Okay, that's not quite as bad. Buy it again at 5, 5, 5, 5, 5, you bring your average way down, and then if it goes back up to 10, you make some good money. So we want to look at each investment relative to the investment string theory. You ever heard of that? The investment string theory? Oh my gosh. Einstein didn't even know about this. I created it yesterday. So if you take a string, your left hand represents today, and the right hand of the string represents, say, 10 years from now, and the string's like this. As I tighten it, obviously it tightens up and it gets tighter, right? So if the downside risk of an investment, if you go in today and look at it tomorrow, the downside risk is quite high. It could go way up or down in any given day. If you give it a month, it may or may not be down a lot, but it's still unknown. And if I start stretching it out to a year, it was down but back up and down maybe, or still down. But as I stretch the time out, the stock or the fund that represents the stock has more time for inflation, more time for the companies to become more efficient using AI or something else. And if they become more efficient and earn more money, they have more value in the company and or pay out a dividend. What happens to the stock price? Goes up. And then the other thing is, the more time that we have more time for more people to be born and countries to come out of poverty, demanding more goods and services. More demand causes what? Prices usually to go up. So the string theory that I made up is, if you pull it out and say, this is now 1 year, now in 10 years, it's probably pretty tight because it's been up and down, but the value from today and the value in 10 years is probably pretty solid. It's more than what you put in, or a lot more than what you put in. But if we bring down the time frame closer to today, then the string gets kind of weak and there could be some downsides. So hence the reason to do short-term investments in cash-oriented, stable investments, intermediate term investments that you might use within 3 to 5 years, and moderate volatility, give them time to reinvest and recover. But the long-term investments, 7, 10 years or more, you tighten the string theory by giving them more time. And there's a better chance that at the end of 10 years, your total stock market index, not one stock, but all of them, most likely will be worth at least the same or more. That's a given, right? But this visual just kind of gives us an idea of that thought process. Don't put all the responsibility on the long-term investment bucket, because it'll let you down if you look at it at the wrong time and think, oh no, it's the end of the world, I've got to get out. I've never seen the stock market in all the years I've ever looked at in charts not recover. But the reason for that is there's more demand each year as more people are being born, fortunately or unfortunately. I heard one report said 8 billion people. That's a lot of people. Another science report said, however, 100 billion people have existed and have died. So
part of this theory, though, doesn't really take into consideration catastrophic economic events.
Yeah.
The stock market in 20, I mean, like something like that could happen. Boom, everything just completely falls apart.
Right. It could take from now till 10 years, it could take it to 12 years. That's how long it took to recover. And if you had a diversified index, you didn't have all your money in one stock. So we're just hoping that people come back like the animals come back to the pond after one's taken. If the economy fell apart and it crashed and didn't recover, then we don't have an economy. So whether you have cash or not doesn't make any difference. You don't have anything. So we're all in it together. So whether it's 10 years for the string theory or 15, it's most likely going to come back. We need that confidence. This is kind of like buying your house. You have the confidence that it's not going to crash and go to zero. You're hoping, I assume, that it will be at least worth what you paid or more. And so what this does is the string theory works more for the later term investments, just to say, look, if I stretch out the time frame, then it brings the risk out into almost nothing if you look at some of the charts. Now, we can't say there's no risk, but if I could put you in a time capsule and wake up in 50 years, unless the earth was hit by an asteroid or something massively went wrong, there's a chance that your money by inflation alone, the stocks will be worth more at that point. And that's all we can go with. Because if something, a caldera blows up or an asteroid's coming to the earth, it's like, let's have a drink and, have a nice party. So we have to deal with what we can. But psychologically, if you invest this money and you put it all in at once and it dips, if we look at it as a 10-year investment, then it takes some of the anxiety and fear away. Because I've sat here at that desk right at the time that COVID hit, and everything fell. Dividend paying stocks, some of the bonds, the regular tech stocks, everything fell. But we had the plan of short-term, intermediate, long-term. So most of the clients, generally, I don't have the statistics to back it up, but let's say clients in a conservative balanced portfolio, they were down maybe half as much because they had cash and bonds and preferred stocks. So when you create a portfolio, it isn't, are you aggressive or moderate or this? We want to see what has this portfolio done in the past. We saw that on the first day. Here's its worst times and here's its best times, right? Anytime I've gone to the shelter to find a new dog, they have a report. Does this dog bite? Does this dog have this problem, this problem? We want to know what the funds are like and then what the portfolio is like. If you don't, or the person doing this doesn't know that, then you're putting yourself into danger and being invested in something that's either too conservative, that's not going to perform, or too aggressive, that's going to scare the life out of you. So the biggest value of having somebody help you do it is to get you through those dips and those bad times. I call my clients when the market drops a lot and say, guess what? What? You're down 10%. What? That's terrible. But they're down 20, 25, 30. Oh, okay, I feel better. And we've got a bunch of money some money in cash, a bunch of money in the moderate. So you can liquidate all this money for the next 6 years. Beyond that, yeah, we want the market to come back. So we need to have coaching along that process, either to look at the string theory and tell yourself, don't worry about it, or if you're working with somebody else, they need to do that. Now, what do we do on a regular basis, or what should you do on a regular basis? Daily, we watch interest rates and politics, obviously. We're all doing that. What's happening today? Did the Fed, you see the market go through the roof, and I can pretty much tell that, well, the Fed's probably planning to drop interest rates. That's usually what's happening in a short period of time. Or if there's a tax bill that you are for it or against it, it came out, it passed, it didn't pass, that might move the market short term. So everybody should watch that if you're doing your own management of your investments and you're doing the maintenance of those investments. But remember, we've looked at cash flow, we've looked at all the insurance policies and just gone through those to make sure that you get rid of insurance you don't need, but you keep the insurance you do need. We know that an umbrella policy is a good idea if your house is worth over $600,000, the first $600,000, if the neighborhood is worth that, is somewhat protected with homestead, but beyond that, you're not. And then your investments, if it's a rollover from a 401k or a TSA 403b, that's protected from lawsuits. But if you've got a big investment portfolio that you sold a rental and you got all this money and your car rolled down the hill and hurt some people and they get a big lawsuit, they're going to come take that investment. So cash flow, insurance, umbrella policy if needed, liability on the car, maximum the liability in case you hurt somebody, but also uninsured motorists, underinsured. Have we heard of that? That'll be in the book as well. If you have $500,000 car insurance, but $30,000 uninsured, underinsured motorists, you're walking through the walkway and somebody hurts you, that's all you're going to get from your own company if they don't have insurance. Because people with insurance are usually more responsible than people without. So auto insurance, you can look it up in the book, uninsured, underinsured. I had a client got hit riding his bike. The bad guy gave him $15,000, but he had his own $300,000 uninsured, underinsured. He got another $285,000. So that's insurances. Then you move to the taxes. It's anybody's guess. See your accountant or do a little work. If you get a little bit of a tax break this year, if you want to roll some money out of an IRA into a Roth to reduce your future required minimum distributions, and you can pay the tax now, fine. But if you can't, then you plan not to do that. There's a million other tax things. If you have non-retirement portfolios, You can have the bonds be municipal tax-free bonds, ultra short, short-term, intermediate-term bond funds. Vanguard has a very good one. I'm not promoting Vanguard, but they have an ultra short-term tax-free bond fund that's kind of nice. You can get a good rate of interest tax-free. So you want to keep things in perspective at that point for taxes. There's a million other things to talk about in taxes. We get much more into it in that class. Estate planning, we all know what a living trust is, a durable power of attorney if I'm incapacitated, financial and legal, and then a will. We can touch on it briefly today, but it's a good idea to learn somewhat. If a married couple don't have a living trust and everything's left to the spouse, for the most part, you can get away with that. But it's a good idea that if both spouses perished at the same time, to have the living trust established and planned out. Or if one spouse passed and the other one doesn't want all the stress and responsibility, then it's a good idea to do a trust. But a trust could be $5,000. You could go online and do it yourself for several $100s. That's a good possibility. And if you thought about doing that, watch some YouTube videos and see if that's the kind of thing you want to do. The main thing is, do you want to do the amount of work? Most attorneys will do it all in a boilerplate, fill in the blanks, and then you have a trust. If they'll sit and listen to you and take your instructions on what you really want to happen, that's worth it. But if they don't, I don't think it's worth it. If you get a boilerplate trust, it just says, you know, this grandkid gets it at 18 and 23 and 25 type thing. So living trust is all relative. Either hire an attorney or not. If you don't have assets that exceed massive amounts and don't have beneficiaries, that's not a problem, but you need to keep an eye on that. And then the investments we talked about before and the portfolios. So daily we watch interest rates and markets. Weekly we want to follow alerts on any of the investment funds that you have. What if your fund changes the way that it's going to be investing? There's a lot of little things that happen. Years ago, I got into an asset allocation fund that had a third in cash, a third in bonds, a third in stocks. For the conservative investors, that's fine. But back then, we didn't get notifications like we do now. You got a little letter in the mail. Well, this company changed it to, we're going to do small cap, mid cap, large cap, all stocks. And all of a sudden, boom, the thing dropped at one point and it went up again. But it's like, what the heck? This isn't supposed to do that. Then you find out that they sent out a little letter. They changed the investment methodology. So it was a good idea that you know what's going on. So most advisors or people that are into it doing themselves should know intimately every single fund in the portfolio. They should know the expense ratio, the performance, the method of how they're buying and selling. Is it an index fund? All of that, each individual portfolio. It's like you know about every food in your pantry for the most part, and then you have the whole thing together. You need to, or the advisors need to know what an exchange traded fund is. What are the benefits and the pros and the cons? Well, you buy them and sell them instantly during the day, so the risk could be higher if you make a mistake. And then if there's not a lot of them, not a lot of dollars buying and selling, you might get a low price. So it's like in the real estate market. If the market's slow and dead right now, you might get a lower price than if it's really busy type thing. Monthly, what we do is screen the funds, mutual funds and exchange traded funds, and make sure we get rid of any of them on our list that have fees that are too high. But we'll look for buying some of them if they are coming up with a new technique or a lower expense ratio. And on a quarterly basis, on our list, we get rid of any that don't keep up with our standards, expense ratio, performance, or whatever they're doing compared to other funds. Then biannually, we want to look at all the funds in the portfolio, and if one's up massively far beyond what is normal, like we had in utilities, we're up like 45%, we sold off a fourth and bought into an area that was down a lot, which was real estate, and it was paying 4% yield. And so we didn't want to risk the utilities losing its favor and tanking. They've held up, but they've fallen back. Because people are like a bunch of people on a boat. If they hear a rumor and they get excited, they go to that side of the boat, and then the boat leans and could sink. So once something is really popular, sure, you could buy some of it, but it's too late to get a hot deal.
It's like that in India. Hearing about it all over the place. I'm like, well, if everybody knows about it, it can't be a good investment now.
Yeah. Well, its value's kind of gone up quite a bit, and kind of like Bitcoin, it's too late to speculate and make a lot of money just because everybody already knows about it. The good thing about it is it's a good quality tech stock, but I wouldn't buy it by itself. But any of your mutual funds probably own it. So if somebody says, well, I own NVIDIA, well, it's in everything. The S&P 500 is probably 5-6%, Apple and Microsoft type thing. So that's why it's nice to own a fund. And if you have a managed fund that charges a little higher management fee and they think, oh my gosh, NVIDIA's just peaking out, here's the history, here's all this technical stuff, we're going to get out of it, they sell it and buy something else. A mutual fund, you could end up paying taxes on that. An exchange traded fund, you don't. You'll pay it later when you take your profits. So that's biannually. Get out of anything that's too high just to rebalance the portfolio because we don't know. If I knew everything, there would be no stock market. I would own it all if you could predict anything, right? But we can't. And as soon as these really smart people predict, then things go the other way. Or these hedge fund managers, they make a lot of money because they get 25 or 20% of the profits. They get 2% if there's no profits, and they can do whatever they want. They can gamble your money because it's a hedge fund, and you've given them permission to do that. The ones that have gambled and failed, we don't hear about. The ones that have succeeded, you hear about. So we don't like to gamble. So biannually, it's a good idea to rebalance the portfolio if something's up way too much and you're just like, I need to sell some of this fund. Individual stocks, that's a big risk. You'll make more, but you could lose more as well. Annually, then you want to come back and do your financial planning process all over again. Confirm, and this is what we tell other advisors, confirm your client's needs, goals, objectives, risk tolerance, and personal health changes, right? As we get older, we taper the portfolio down if it's a generic balanced portfolio and the person's getting older because even if you have long-term care insurance, it doesn't cover everything. Or maybe the person wants to scale down. So we talk to them at least on an annual basis about the financial planning process because you might get more aggressive as we get older. Why? Because maybe you're starting to take Social Security and that's like having $500,000 in bonds. I'm going to take the dividend off it. Maybe it's like having $1 million. Or you may have grandkids at that point, you've got more money than you need. Then you say, look, this is really for the grandkids. Let's start turning it up a little bit. Let's not be so cautious. We have that all the time. So the daily stuff, we want to watch for what if interest rates change, obviously, and law changes. And we saw this. Property taxes now, if you have, and state taxes up over 10,000, you can deduct up to 40, but it's only for a few years. That was a little sales pitch. Inheritance tax, we don't have inheritance tax in California. In the Fed, they raised that. It did go from 5 million up to about 12 or so, and then they bumped it up, I think, to 15 million, and that's not going to drop back down like it was going to. Not many people have that problem, but businesses and other things have that. Capital gains tax, that hasn't changed much, but the added deductions that you get, like the standard deduction went up a little bit, or if you itemize, you can write off more of the state and federal taxes. So if that brings you into a lower tax bracket, it's possible that you could drop yourself down into a 0 capital gains or a low 15% bracket. So those are nice, but I don't know how long they're going to last. 1031 exchanges, we know that. If you have rentals, you can trade this one for that one. That we were worried about losing, but that hasn't gone anywhere. So if you or anybody you know has rental properties, and if they're sick and tired of them, they can go through a process called the 1031. They can do all the proper paperwork. They can do the ads properly. They can sell their rental, and then they can give it to a transition company who holds it, and then that company puts it down on the next purchase, and they can avoid all the capital gains. Now, capital gains for an individual, if a single individual bought a house, I don't know, say for 100,000 years and years ago, and it sells for 500,000, if they sell it, they don't pay tax on the original 100, and then they don't pay tax on the next 250,000. That's an exclusion, so 350. But they would pay tax from 350 up to 500, unless they had improvements and all these other deductions, right? A married couple, they get 250 and 250, so they get 500,000. And if they both bought the house for 100, they have 5 plus 100. They could sell it for 600 or less and not pay any taxes. So be aware of that stuff. Before you say, I'm selling my house, just see your accountant and see if there's a lot of gain. There could be gain in there, so that could be an issue. The good thing.
Do you get that once, or do you get
You get it up to $250 for each residence if you've lived there 2 of the last 5 years. So if you bought a house for $100, you could sell it for $350, but $350 everything over that's taxable one time in that house. But if you buy another one and stay there in the last 2 to 5 years, you can take that deduction again.
Oh, so you can have it repetitive
Yeah, but
if you stay there 2 to 5 years.
yeah. Yeah, and I would confirm that, but it's your residence, and if you've been there 2 to the last 5 years, because if you move into your rental, and oh no, that's a rental, I've depreciated it, you can move into it and stay in it in 2 of the last 5 years. And to go a little deeper, normally if you sell that rental and you've depreciated it, you pay tax from the depreciation lower amount up to what you got. But if you move back into it, all that depreciation amount, if you live there 2 of the last 5 years and then you died, you would get a step-up basis for your beneficiary. So learn all this stuff. Or if you say, look, this is too much for me, I'm going to hire a CPA, I'm going to hire an insurance agent, and I'm going to do the investments because I don't want to worry about those. Just talk to those people regularly. Tell them what you're doing. So they know what you're doing. I talked to my 401k manager today. Okay, I'm going to start taking money out of the 401k in January. I know it's better to wait until December because I can make more interest, but I just want it organized and I just want a monthly income and then let my business income stay in the business. Well, I learned today that you got to have all the distributions for that year out by November 1st. Not a government issue, but the coordinator of the plan wants it done so they can get the 1099 right. I didn't know that. So I'm glad I called and talked because I would have kept doing it and gone into December and then that messes up the 1099. So I'm going to take out 10 months instead of 12. But you don't know those things unless you ask those people. So you can carve out any part of the planning process you want to do and not have to have anybody else do it. But when we get older, I want to go bounce on trampoline on Saturdays. I want to be in the gym. But I tell my son, that's why we cloned you, to take over the business someday. But I'm not going to get out of it. I'm going to do it more for fun. That's why we're here. This is going to be fun. We're going to do this quarterly on 10 o'clock and 6 o'clock, and we're going to have a few more people and a wine tasting and all that kind of stuff. So kind of fun. But
Next thing you know, we'll move a trampoline.
That's right. That's right. We got to do the ceiling up there. Yeah. But I do remember any day could be my last day. So, ouch, oh, this broke or something. Okay, you're done. That's why I'm getting all the pictures I can. Who knows? But there's a 94-year-old lady on YouTube that does a floor exercise routine, a cartwheel, a front roll, a back roll to a headstand. A headstand. I'm terrified, but she did it all her life. So these are the other things to check on, just see if things have changed. And that was a big deal with the last thing on the tax bill. Weekly, we recommend that you just using phone apps or computer programs, just take a look at some of the funds that you have. And, you know, there was a fund that my son's watching now, and it's a preferred stock fund. I had 2 of them. One was a mutual fund that charged a higher fee, and one was an exchange traded fund, lower fee. And when interest rates went up, one dropped more than the other. I'm going, what the heck? And I was lazy. I didn't spend the time to find out. One held more convertible bonds, and the other one held more preferred stocks. So the convertible bonds were more interest sensitive if interest rates go up. Oh, I get it. So you have to do a deep dive, or you're going to be surprised all of a sudden a fund that you love tanked. And if you don't understand why, then you're apt to get out before it goes back up. And the good news is most of these things are listed in the book, but this is a good one on a weekly basis. So update the funds. Changes in management, like I mentioned before, or technique or what they're doing. Some may have dropped expense ratios. Vanguard dropped all of its expense ratios across the board for the most part. That was a competitive move against other companies. Regulatory issues, performance compared to the category, liquidity issues, and all that. If you buy a stock, if you are worried about if I buy it today and sell it tomorrow, one, the market might go up and down, but what if hardly anybody own the stock? Then the values could fluctuate a lot more because there's not enough buyers. So if you want to not worry about the spread, then you might buy Microsoft or Apple or even Tesla. Yeah, the stock might go up and down, but there's the spread between what you want what you can sell it for shrinks to where you're not going to lose money in a bad market because there's not many people buying it. Something to know. It's called the spread. All these other things that are important to know about the funds in themselves. Monthly, listen to quality podcasts. That one, ETF Prime, is good if you want to listen to people. There are others. You can just look up ETF podcast. But that one, I think, I always listen to because they don't tend to be selling things. And there are a couple, the guy that runs it, he's kind of nerdy, but, in a good way. You could trust him type thing. But there are others out there that are really good. Shop and research for new funds. Either you or your advisor should be doing that. We have software, let's say Morningstar. We can get a column of 25,000 funds, let's say, and tweak the columns to where give me the cheapest expense ratio, give me the best performing, and tweak it around, take the top ones off the top, and then look at adding that back to our list. So we go shopping for better products. And a better product would be a fund that does or doesn't do what you want it to do. An S&P fund doesn't do buying and selling. It just goes out and buys all 500 stocks in the percentage of which they make up in the market, weighted percentage. So that S&P 500 fund should be the cheapest thing out there. And so the big brand names who have the biggest funds, they'll give you the cheapest price. It's like a loss leader to them. Come on in. Fidelity, and you can do your own homework, has a total stock market index fund for 0.015. But is that a loss leader fund just to get you to go into Fidelity or not? We'll see. Vanguard, Schwab, and all these other companies, do your homework. An index fund should be big and cheap, but a managed fund should be small and more expensive, because if it's a smaller fund, they're more agile and they can buy and sell and maybe go in the right direction for you, versus the big fund. They can't buy and sell and move mountains. That's too big, and that's not a part of their goal. So small isn't always bad. Review the desired funds. Yeah, you want to have a fund that has a required minimum size. How long has it been around? Especially these new exchange-traded mutual funds that trade like a stock. Look for replacement exchange-traded mutual funds. This is important. If you have some old mutual funds in a retirement plan or not, I would look at, one, what does Morningstar think about them or anybody else's rating? Is it a reasonably good fund? They don't show it as a negative or, alarm and 1 star and get out of there. And if it's a pretty good fund and it was a great fund that you bought 30 years ago, 20 years ago, 10 years ago, the competition now is coming out in the form of these exchange-traded funds that hold the exact same thing as a mutual fund. But the mutual fund, you buy and sell it at the close of business every day, and Vanguard, Fidelity, Schwab has to do all the paperwork. And you get it for what it's worth at the end of the day. That's not a bad thing. But they have to do a lot of work, and they're saying, wait a minute, let's set up the same fund, but in an exchange-traded mutual fund, so you can go buy our product in the mall, in your brokerage account. We'll still get paid to manage it, but we don't want to do all this paperwork. So you buy the exchange-traded fund, which is it is exactly the same as our mutual fund, except its value fluctuates throughout the day, and then it ends up being the same price as pretty much the mutual fund does at the end of the day. So the exchange-traded fund is where everybody's going, because it has better tax efficiency, and most of which, not all, many of these funds have lower expense ratios. And so some of the old companies that you heard about, very respectable, they're slowly giving in to letting some people in the future convert the fund to an exchange-traded fund, which is slightly more tax efficient. Not all are doing that.
Some funds have Admiral shares. What are those? There's usually a higher minimum, but what are those?
Vanguard uses Admiral shares. It used to be in the old days, you bought an investor share or an Admiral share, and it had to do with the expense ratio. The investor share might have paid 20 basis points or 0.20, but the Admiral share, if you had over 100,000 or something like that, only paid 0.10. Now, they're in the process of eliminating that and equalizing everybody. But different share classes may have to do with the expense ratio. But like I say, competition is getting rid of that, so Vanguard can't do that. Because if you had $500 or $300 in an account in Vanguard, they wanted a higher expense ratio because they got to do a lot of paperwork for a tiny little investment they're not earning much on. But if you had 100,000 there, they're earning more, so they could give you a reduced fee. And your biggest funds are the passive funds like the index fund. The bigger they get, they can reduce the fees to take business from other people. But if it's a managed fund, you'll look at Vanguard's managed funds. They're not very high, but they're a little higher than the lowest cost index fund. But you could look at on Morningstar, which fund is the top producer, who made the most money last year. It's usually whoever gambled on something. If they gambled everything on gold, and now gold is 3,500 from 2,500, and now they're up a lot, that's great, but can they repeat that? I would really question that. What I'd want to do is see a mountain chart where the index is similar to this fund, and then there's another one category, and if they're similar to the fund you're going, if we have a little more or a lot more gain, then you can have the fee. You're doing something right. But I always question, what are you doing that's so brilliant to make money, and can you do it every year? If they go out and kick the tires and look at the companies and make sure they're legitimate, look at the books and encourage them to do AI and all that, that's great. Because one of the best funds, in my opinion, for what I would like to have, and I have most of my money in, is a dividend growth fund. What's that? That's a fund that buys quality stocks, some growthy, some blue chips, Microsoft, Apple, all that stuff. And whoever is increasing their dividend each year, meaning making more profits, is probably doing a pretty good job. And they're likely going to be buying companies that are going to benefit from IT, right? And AI, right? Got that backwards. Oh no, I showed my age. So if I gave you money and you're going to go out and buy 200 stocks, and you're going to look for companies that are growing but increasing their earnings each year, and they're really good at it, and they're going to bring an AI to help do that, like a Walmart or somebody who's increasing earnings, that's a nice fund to be in, because it's not just we're going to guess on technology and hope it's going to be right in the next 10 years. It was in the last 10. Will it go up? I don't know. But a dividend growth fund, dividend growth, all the big brands have it. They're looking at quality stocks that the companies are growing, and they're growing their dividend. So if I hire a property manager and he or she's managing all my properties, and that person makes the right improvements and tweaks a little here and raises the rent a tiny bit there and reduces the expenses, wouldn't you want somebody like that to keep an eye on things? So that's what we want to do overall for the portfolio, but we do want to balance out into some other non-correlated investment funds if the market goes down, and negatively correlated. So a negatively correlated investment would be something like gold or T-bills. Stock market goes way down, they hold their value or go up. So they're negatively, they do the opposite. A non-correlated would be stocks that are a little different, like real estate stocks are a little non-correlated to tech stocks. So they might both go up and down in a good market, but if the market crashes, tech stocks might drop because technology stocks drop, and you love your real estate, or vice versa. So looking at replacing, okay, so if you have mutual funds and you're into this, or your family member or advisor's into it, they should be looking for new exchange traded funds. Not all have low cost, some of them have high cost, but looking through the crowd and finding the same fund that you have as a mutual fund, almost identical, but in the form of an ETF and a lower expense ratio, I'd rather do that. So we try to slowly drift into exchange traded funds for our clients, so we can get them in more tax efficient, if they're not in IRAs, and lower cost funds for the client. This is what you or your advisor should be doing for you. Then on a quarterly basis, allocation of each fund, we then want to look at expense ratio, and the last one was, let's go on a shopping spree. This one is, we're going to declutter and get rid of some of the funds. Is the allocation portion too much? Okay, get rid of some of it. Is the expense ratio from the highest? We lined them all up and this fund has the highest. If we can't justify it, then we get rid of it and replace it with a lower cost fund. Some of the high cost funds, however, have such a good mountain track record that we can't get rid of it. And we tend to have more bond funds that are managed than not. Bond funds and bonds don't have a stock market exchange. So you can't just go there and sell your bonds or buy the bonds. You've got to go on the secondary market and have contacts of who's going to buy your bonds and who's going to sell you bonds. So if we do that, then we would rather have some big names like JP Morgan, Vanguard, Fidelity, whoever, but we want to make sure that there's a little bit of management in the bond funds, because there may be a time where you can't sell the bonds. Junk bonds, high yield bonds are great, but if the market crashes and everybody's worried, you might not be able to sell them to somebody. You may not have a buyer at all. So you want to make sure that whoever's managing your bond portfolios know what they're doing if it has to do with higher risk or anything. If it's just one of everything, you can get an index fund. That's no problem. So other thing, historical risk, is that fund within the standard deviation roller coaster ride or beta comparatively. So standard deviation, just look at that as the farther you go out on the diving board, the more bouncy it gets. The more you go to growth stocks, the more volatile they're going to get. String theory it really comes into play. I'm going to play that up because I'm so jealous of Einstein. My biggest fantasy is if I could be really smart. But so we'll play that up. And Hunter invented the string theory of investing. I'm creative, give it that. Morningstar rankings and high to low. You can go to Morningstar on your own, right? And you can look up a fund if you want. Morningstar will give it a star rating of 1 to 5 stars. And that tells you what, if it's a 5-star, it's in like the 90 to 100% percentile. So it's a historical from today past. Where does this fund rank compared to its index and other funds like it? And is it a 5-star fund? That means that its performance has been as good or better than other funds like it, 90 to 100%. Sometimes, though, it may be an outlier that it doesn't make sense because why is this fund so good, but it's not? If it's an index fund, it might be more of a 3-star neutral. There's no reason for it to break out of the index. But if it's a managed fund, it could go to 5 stars. So star rating gives you the historical performance. 3, 4, 5, I don't have a problem with. 1 and 2, let's find out what's going on. And it may be that you have a new fund that does something different. There isn't a good index to compare it to, so it's only a 1-star. That's okay, but I want to know why that is. The other thing is they give it a metal rating, gold, silver, bronze, and neutral and negative. So the stars just said, where does it line up quantitatively? But on the metal ratings, that tells you what Morningstar thinks about its process. If it's a gold rated, Morningstar thinks this is a good company, Vanguard, Fidelity, Schwab, iShares, and their process makes sense to us. It looks like what they're doing is legitimate and they're doing a good job of it. That's good. The engine under the hood type thing. And then how are the people, and has the manager been there for a long time and they're continuing to do this? What's the reputation of the company? Some companies have a bad reputation. They get fined by the SEC. You don't want to deal with somebody like that. So with Morningstar, the 5 stars only tells you where it ranked historically. It doesn't tell you where it will go. And the metal rating only tells you what the engine is under the hood and everything's good to go out into the race. Now, whether or not that fund's category is lucky or good, that's your problem. They're just saying, like in a race, okay, we've looked at all the parts on this race car, you're good to go. You can still crash, but you've got everything working for you in your favor. So neutral to 5 stars, I don't know, bronze or something, but if it's a low rated and you want it, just read their analysis and see if you agree with what they say. You can always Google it and there'll be somebody out there, some investment nerd that has information that you want. Don't consider everybody because some of them don't tell the truth. Down here, bond durations. It's a good idea to know what the highest to the low duration is. And all that means is, when does the bond mature? A 30-year bond that matures in 30 years is a long-term duration, right? The time frame. A 1-year bond would be a short duration. You want to know that because if you have a fund with a bunch of bonds in it, oh, that one has the best interest. I like that. And then you find out they're all 30-year bonds. If rates drop, you're going to kiss your advisor and here's a cake. Thank you so much. Because these were long-term 30-year bonds paying 4%. Now, after the Fed chairman got mad and quit or whatever, and the new person dropped rates down to 2%, now you can only get 2%. And you made some money on your bonds if you resell them. But the reverse is true, that if you bought into a total market bond fund that had a long duration and rates went up to 6 and you're getting 4, good luck selling that bond. And you're going to see it in your statement, it's worth 20% less or more. So why is that important? Because the duration is key to future volatility and risk of the bonds. Okay, it's like if you bought a rental and signed a 30-year lease at today's rates and it only increases 3% a year, that would be crazy because in 10 years, rates probably have gone up quite a bit more. So you wouldn't do that. So 30-year bonds, we don't like funds with long-term bonds in them. There's a duration that risk that says this 30-year bond probably has a duration of about 17. And I won't go into what that means. My son can repeat it. It's too complex for me. But it means that the thing I'll say is that this 30-year bond, if rates go up 1 full percent against you, the value drops by 17% per 1%. Now, if rates go down, then you'll go up 17%. You'll be a happy camper. But it's not worth the risk. The only person that should risk rates rising and falling would be a pension plan who has to lock in today's rates for the future, or grandma that just sold her house and she doesn't care what the resale value is. I want that 30-year treasury bond. Give me my 4%. Rates go up, she's not even going to care. That's her beneficiary's problem. So duration, if you or your advisor isn't keenly aware of that, they need to get into that. They need to learn about it. And if you're not doing it, hand the book to the advisor. They can read it. They should spend the time knowing it. I don't want them to send the money off to the home office because there's a fund I showed you before, the Vanguard Balanced Index Fund. And I always talk about this in my classes. I love this fund. 60% stocks, 40% bonds, expense ratio 0.07. However, the bonds in the portfolio had longer term maturities than I'm comfortable with. And I'd say that in the class, be advised, there are longer term bonds if interest rates ever go up. And in 2020, rates did go up, right? So the bonds and that fund, the stocks and the bonds, the whole thing was down 20%. It should have only been down maybe 10, with the stock market down 20 and the bonds not down. But because they had longer term bonds, it dropped. Now I say the reverse. Now we don't mind, because if interest rates have nowhere but, let's say, flat or down to go, I wouldn't worry about that too much. We still don't get into long-term bond funds. It's too risky. If you have all your money in bonds and rates fall, the bond value goes up. That's really nice. But if rates go up, then they go down. Well, we're going to have ultra short-term bonds that if rates go down, we're going to go, oh, darn, I wish I had those 30-year bonds. But if rates go up, we're protected. But if rates go down, our stocks will go up. So we're going to make it on the other end. But I've never seen it worth owning long-term bonds if you need to liquidate that money. In 1980, I watched those bonds drop 50%. And if you look at some Vanguard's extended duration 30-year treasury bond fund, not Vanguard's fault, it's still down 40% over 10 years because interest rates had gone up since they had dropped at the low rate. If you bought it when you were only getting 1 or 2% from that fund, and now you can get 4, who would want it? So you lose quite a bit. Best performance, lowest to highest. These are things that we do on a quarterly basis. We look at all the funds and we line them all up on Morningstar, and I'll reverse search the column. What's the highest expense ratio? Okay, justify your expense. And if it can't, then we replace it. But you also want to look at performance. Has this fund performed relative to its index or its category? Or if it hasn't, is there a good reason for that? That's fine. But we want to know that. And if you're managing your money, manage it like it's your money, obviously. And if somebody else is managing it, they should manage it like it's their money. Biannually, we mentioned monitor the portfolio, monitor fund performance, the performance of the portfolio relative to whatever else is going on. I always look at the downside. So when the market tanks 20, I want to be down 10% or less. That's a good selling point that I can call and say, the market's down 20, but you're only down 10. There's value there because we didn't let you lose as much. hopefully. Can't guarantee it. This last time in April, it was amazing because there was a big fear of the not pandemic, but the tariffs, and the stock market dropped a lot, but bonds really didn't get hurt. Some of them actually went up. So when I was looking at, oh no, the stock market's down 20% intraday, 15% at the end of the week or so, okay, then I'm going to have to tell my clients we're down about 7 or 5 or 6. But we were down a lot less only because the people didn't get afraid of the bonds. They actually went up in value. That was a one-time little fun point. But normally I'm prepared to say you're down half as much, that thing. So review changes. Obviously your portfolio changes. I had a client recently that had 60, 40, 60% in stocks, but now it's 70 because the stocks went up a lot. So I got permission to reallocate it back down, even though we think the market might go up in the future. Because it's her nest egg, we need to be responsible and sell off some of that 70%, bring it back to 60 or 65. The problem is every fund she has in there has gone up, so there's some capital gains we have to pay. But this year the taxes might be better because of this tax bill thing. So this is another time to look at converting to Roth, pulling money out, or rebalancing if it's not inside of a retirement plan. So desired allocations would be that. A standard deviation is the up and down from its norm. And the portfolio itself should have a standard deviation that's comfortable for you. When I talk to my clients at the end of the year, I have some boxes, 5%, 7.5%, 10%, 15%, 20%. And then we need to confirm because things change. We have you checked off at a 7.5% standard deviation, historical volatility. What are you thinking? Are you more aggressive because you're leaving the money to somebody else, or less aggressive because you don't like the current administration or something? So we want to reconfirm what your risk tolerances are, because you don't lose money if the market falls. You just lose the ability to sell it and not lose money. If you sell it, you could lose money. So everything's kind of relative. Short-term, intermediate, long-term string theory. So we need to be aware of the average ups and downs of the portfolio, because you can increase and reduce it just by the different funds that you add to it. It's like a recipe. If I want to reduce the risk but have all stocks, then I've got to buy less volatile stocks. We have a fund out there. There's one out there that is it's called a S&P 500 low vol, short for low volatility. All it does is, for its higher fee, is it picks all the stocks in the S&P 500, let's say the top 200, and the ones that have the least volatility. Well, we know that's going to be the least growth, but if you just want to have the biggest stocks in the S&P, but you want the least volatile stocks, then you buy an exchange traded fund, you hire them, and instead of paying 0.10, it might be 0.25, 0.35. If they're having to rebalance that and do something, they're going to charge a higher fee. And these fees are radically low compared to 20 or 30 years ago. We used to pay 1.5% for a fund, and the mutual fund company would buy and sell things. Now it's 10 times less. That's really good. The other thing you want to know, and it's covered in the book, is beta. That gives us an idea of what the portfolio is combined, or you can look at individual funds. Beta is how much risk does this have compared to whatever index you're comparing it to. So if we compare our portfolio and the S&P 500, we want a beta of 0.50, meaning our portfolio might have similar risk of about half as much, 50 basis points. Now, if you say, well, that's fine for you, Bill, but I'm an aggressive investor, then you want a beta of 1.0. It's the same risk as the S&P 500. You might want a beta of 1.2, more risk. But we look at that with X-ray eyes, and I want, for most portfolios that are a nest egg, I need to make sure, almost like we probably should do a blood pressure machine. Okay, the market just fell. You lost 50,000. How are you feeling? 100,000. 200, and then we find out what your real threat is. Because in the string theory, if you wait long enough, you're going to be fine. It's the shorter than when it recovers time that if we panic and get out, you lose money. Go ahead.
What is the S&P 500?
A beta, yeah, 1.
Oh,
Yeah, 1.0 is the same as whatever index that you're comparing it to. So we're comparing it to the S&P 500. Our beta would be 1.0 if we're the same risk. if we compare it to all tech stocks, our beta might be 0.80 or something. So the thing we want to remember is if we look at your portfolio or individually a fund, the beta is going to tell us how much risk do we have relative to whatever index you're comparing it to. So that you go, well, that's too much. 1.0, you're picking stocks or funds. 1.0, that's just as risky because the average volatility, the S&P, I'm going to guess is about 17% up or down from the norm, right? And if I'm 1% of that, I'm 100% of that, right? So I'm going to back up and I'm going to change the funds or the stocks and start getting more low volatile stocks and reduce that beta from 0.10 down to 0.8 or 0.7 or 0.65. I can't guarantee it, but it's really wild how it works. Market just dropped 10, our beta is 0.50. Many times it shows up as we're down half as much. I can't guarantee that, but it's a starting point from the present going backwards. It's a lot of advisors call it back testing and all that stuff. And we have to tell you that the past is no indication of the future at all. But it is nice to know that if I go to the shelter and I find a sad dog sitting there, that I see its background. If it has a habit of nipping at people or biting or barking, but maybe it has a habit that I want it to do. If it's a watchdog, you're not allowed to go there and get watchdogs, but they want it to be a little puppy and it has to stay indoors, right? Can't be sleeping out. So these are just all, we haven't even touched all this stuff. So it's a good idea, like if you're going to go on a hike and I'm at that welcome center and you show me the map you're going to go on a hike on, I can instantly know, is this risky or not if I'm into that. I can read maps. That's all this is. So if you want to spend the time learning all the little individual things and learn something every day, keep your mind active, this is for you. If it's not and your family member wants to do it, keep your ear out in case they go down the wrong path. Whoa, 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 I think I remember something's not good about this. And then you can look it up. If you have an advisor doing it, same thing. You can keep your ear to the ground. You could say, you know what? Can you do an analysis and tell me, you've got all these different funds. Can you give me the average expense ratio for the overall portfolio? This fund expense at 0.45, 0.04. What's the average of all the fund expenses? And the reason that that's important to me is if I work for a big brand name company who also sells their own funds, they might have me in their funds that might have higher expenses. Or I might be with a big company that I can use mutual funds of anybody else's. But my company might require XYZ mutual fund who has a high expense ratio that their advisors can sell, put it in their portfolio, but my home office wants a part of that fund's expense ratio. Now it's a higher cost. You got to be careful of that. Some investment brokerage accounts, Schwab, Fidelity, Robinhood, if they let you buy mutual funds, they want the fund company to pay them part of the management expense, just like the exchange traded funds. It's such a small fraction you might not notice it, but Schwab gets paid by charging all these companies to be on their platform, and you can buy it from Schwab. They don't charge you anything to buy it because the fund manager or the company has to pay them an itsy bitsy tiny fee to be there, or a dollar amount fee. Now, if you have a Schwab and you say, I want in my brokerage account to buy Vanguard Mutual Fund, they charge me like $15. But if you go buy a Vanguard Exchange Traded Fund, there's no cost there because they get a little bit of the spread for making the market like a real estate agent, and they make money off the cash that sits there in the account. It's all legal, but it's a good idea to know these things. So beta is the relative risk. Alpha is kind of interesting. If I have a managed fund and I think I do better than everybody, if you can compare me to the index, the S&P 500 fund, and this is a closed fund, T. Rowe Price Capital Appreciation. Long-term fund's been around for a long, long, long time. Its alpha is probably a positive number, meaning it's a little better than the index and other funds like it. It's close to new investors, but they buy quality stocks. So you'll always hear this term, seeking alpha. If you do something in your fund that causes you to do better than everybody else, we call that alpha. Now, I say be careful, because if you invent alpha, did you do something that might not repeat itself or might be risky? How do you make alpha on real estate? You buy this rental free and clear, pay cash for it, goes up 10%, you made 10%. But you want to add some alpha? Borrow on it, let the tenant pay the payments, put 10% down, it goes up 10%, you just made 100%. You have a positive alpha. But we know that if I borrow a lot of money and the tenant moves out and the real estate market crashes, that might turn out badly. So when you have funds that have a positive alpha, they're trying to do something different than what other people are doing. For example, S&P 500. We've got an S&P 500 fund and a gold fund. And we take 90%, put it in the S&P 500, and it'll go up with the S&P or down with the S&P. But we also buy 10% gold. Well, if they did that last year, they have alpha. The gold probably went up more than they expected than the S&P 500, so they built back in alpha. So I always say be a little careful. Seeking alpha, find out why they're doing better than other funds, and if it makes sense to you, go for it. But funds that have alpha all the time aren't always better. Now, when we do a portfolio, we end up having alpha better than other portfolios like it, simply because we bought funds that had the lowest expense ratio. If the industry average of all the mutual funds and ETFs expense ratio, I'm going to guess, is 0.75, and our expense ratio is 0.15, 0.20, we automatically build in 0.5% or more of alpha. And sometimes we look better, maybe, hopefully we pick the right funds. That's an inexact science, but reducing expenses and looking for only the best managed funds and best construction funds can also build in alpha to your portfolio. So it'd be interesting to see whatever portfolio you have, to put them all in Morningstar, come up with a printout, and we showed you the first day, we can go to the bottom of the page and give you the average expense ratio of all your funds. And if it's really low, great. If it's a little bit higher, is there a reason for that? Okay, no problem. These are managed funds, bond funds. But if it's kind of high, and I'm buying it through an advisor whose company lets them use those higher price mutual funds, the advisor should be trying to reduce the expenses. But the home office sometimes won't let them do it because they may or may not have an agreement with that mutual fund company to earn part of the fees on their platform. So that's not illegal, but it's good for everybody to know. How does Uncle Schwab make money? Fidelity, everybody else. They do it by parking your money in cash, giving you 0.5%, and they earn 3 or 4% on it until you use the cash. If you buy or sell something, if the spread price changes from what you want but what you get, they're the market maker, so they can make a little bit of money on selling you shares or buying the shares from you. It's not outrageous, it's regulated, but there's a lot of little tiny ways that people make it. And my complaint with these big companies that have advisors under them, the company I work through is called Osaic. They have 8,000 advisors, and it's several different companies. They don't tell me, other than regulatory requirements, what I can and can't do, as long as it's ethical and it's with the rules. But a lot of these people that you walk into and you've got a big brand name, that company controls that advisor all the way down to here's what you can offer, and they've already decided it may be funds that they could share in part of the expense. It may be funds that they sell out of their own box, or it may be their own funds. And the regulators are constantly closely monitoring that to make sure it's not unfair to the investor. So you're not being taken advantage of, in my opinion, if it's a big brand name company, but there could be ways to drop the expenses and get better services, and at least know they're doing this stuff for you. Because my complaint for the advisor says, look, you need to manage the money yourself, or at least have models that you manage, or follow somebody's models. Because for you, Mr. or Ms. Advisor, the SEC is going to come in and saying, you're charging 1.2, what are you doing? Well, I shipped it off to the home office. Okay, what are you doing? Well, I took my client to lunch. Okay, what are you doing? I want to be a part of the financial planning process, the cash flow, the insurance, the estate planning, the taxes. And kind of like that person that runs up, this is a bad example, runs up to your car and washes your window. You want to prove that you give value back to the client, not just take their money, because, and we'll probably see it on one of these charts, the SEC regulates against reverse churning. Have you ever heard of the word churning in this industry? That's back in the day where your broker bought and sold and bought and sold and bought and sold, and they made 1% to buy, 1% to sell, and all of a sudden you don't have anything left in the account. Now reverse churning is bring your money to me, and the algorithm will balance it out and manage it, and they do nothing. So right now the algorithms and the computers are taking them off the hot seat, but they're not really doing much. In my opinion, they need to look at the portfolio, remember the notes in the last conversation, or call you and then make adjustments to it when it's time to make a trade, because your situation may have changed. I have a gentleman yesterday, he's has dementia problems. His mom left him a lot of money. We used to have great conversations. He's into more stocks. But after meeting him again, and we hired him a fiduciary to manage his bills and things because he's having serious memory problems. He can't remember much. It dawns on me, this is on me now. It's not on him telling me this is what I want you to do. Now I have a lot more responsibility to start toning down the risk because he may need home care and a lot more money. So it's not a matter of getting his permission to say, I want to tone it down. I have to make that decision based on his situation and all the notes and do what's right for him. I don't want to stay in the high risk level and the market crashes and now he needs $20,000 a month for care. I have to tone it down a little bit and be responsible for what his needs are. That's where the advisors are going. We have severe ethical requirements and morals. There are moral causes now in our continuing education and our licensing now, that if they don't do what's right for the client, they get in a lot of trouble. So the companies regulate all this, and it's getting back where it should be. Alpha, list of funds and harvest the gains, that's possible, and reallocate if you have a fund that's up like utilities, it's way up, and then we looked around and Vanguard had a real estate fund that was down 16. We took a little bit of the profits, put it in there. It had a super low expense ratio, earning 4%, and it was down 16. We bought it for the income, but then it's come back up nicely. Strange story, the utilities went up because of all these AI centers that are planned. They're going to be moving a lot of energy around. The real estate, after we bought it, luckily, we didn't know this, went up in value because it started to buy AI centers that are being built. So that makes sense, but now it's too late to jump on those. And I didn't know that was what was going on. I wish I did, and if I was that smart, we'd all be in utilities and then real estate and billionaires. So that's what you do biannually. Annually, you come back and look at your cash flow, like we mentioned, insurances, what do you need to get rid of, but most importantly, what do you need, and those things that we mentioned. And also, we encourage people, please tell younger people about this. Insurance is not the most exciting thing in the world to think about, but it's the best thing that will ever rescue you if you have a loss. You don't want to use up your own investments. So if you need extended medical care or long-term care, definitely by all means do it. But if you can't buy it, you have to self-insure, and that's a part of the allocations and things. But I have a saying, and this is not to say anything bad about insurance, but the best that you can ever hope for from insurance was that it was the worst investment you ever made because you didn't have to claim, right? You didn't die, you weren't disabled, and insurance is the best thing you could possibly have. Especially when you start off, we've got to have all these coverages. I end up preaching people about auto insurance, maximum liability, uninsured, underinsured, bring it up to 500,000, umbrella policy, travel insurance, medical evacuation. I don't sell insurance, but it's the most important part of a financial plan. Cash flow so you can pay the premiums, but then the insurance, and then the taxes and the estate planning. The estate planning, obviously, we remind people if you have a living trust, make sure you change the title to the accounts that are necessary. The house would be important so you get a favorable tax treatment if one partner passed away, if there are two. If it's a single person, there's no partner, then obviously you need a trust in case that person passes away. A husband and wife or married partners, not as critical if you have beneficiary provisions on there, but it's better to have it if you're legally married in community property or in the trust that will claim community property because you get a favorable tax treatment. So if you have joint tenancy and both spouses die at the same time, you got a problem because then the state's going to step in and say, first of all, who's going to get this? you can get a transfer upon death provision there now. But if it's joint tenancy and both spouses die in a car accident or an airplane crash, now you could have probate. So one good thing I tell people that are partners or that are married, if that partner wants you to go somewhere and you don't want to go and you don't have a trust and the house is in joint tenancy, you just say, well, sorry, honey, I can't go because if we drive there and get in an accident, my advisor says, you know, we shouldn't drive together. So that's my little joke. So estate planning, things that need to be in the trust, they call that funding the trust. All this stuff is easy to understand if you have a lot of rental space in your brain. You want to watch YouTube videos over and over and over again, you go, I get it, that's easy. But today there's so much information to learn, we have to specialize if you don't want to do that area and specialize with somebody that can. So there's a lot of YouTube videos out there with attorneys that are very good. Make sure whoever's doing things is accredited and licensed and all that. Tax planning, the things we talked about. This is a great year to see the accountant and do some reviews, or at least watch some videos on what you should be doing. You've got a little window of opportunity for the next few years, possibly. Investment quantity, and quality. You want to look at the investments and slowly start increasing quality as time goes by. Meaning junk bonds, they're okay to have on a small percentage. They actually have performed quite well, but it's just kind of scary to think that it's a junk bond with a low credit rating. They have really good yields. I've even seen them go up when stocks go down. Or I've seen when interest rates went up, causing most bonds to fall, high yield bonds didn't fall because they had such a big spread that they were earning such a high yield, people didn't want to get rid of it. But you don't want to do all high yield bonds, junk bonds, unless you're a specialist at that, because there could be a bad time in the year and you'll regret it. Portfolio allocations, again, look at what is allocated and where it should be and how you want it to be allocated at that point. Change the risk tolerance if it's necessary. Some cases, like I said, you inherited money, you started taking Social Security, or you've got more than enough. Now you're planning for your next generation of beneficiaries. When they get the IRA, however, as you know, they have to start taking it out within 10 years, all at once or a little bit over 10 years. And so that can be an issue. Spouses, legal partners, if a spouse dies, the other can take it over either's life's expectancy. That's not a problem. But if somebody younger, non-spouse inherits it, then they have to do that. But look at the risk tolerances. And we don't want to fall into something that is known as recency bias. We don't want to think that the market went up a lot last year and it's going to go up next year. Or it went down a lot last year and it's going to go down. You have to do whatever the plan calls for and stay within that plan, because if the market goes way up and you add to it and it crashes, or vice versa, it's not going to work within the plan, and then that could force you to get out, right? So people doing real estate things, if they get a big mortgage and they can't afford to pay the premiums or the mortgage, or the tenants move out, you've got some serious problems there. So try to balance things based on the risk tolerance that you want to do. Is it for you? Is it for your spouse, if you have one, or is it for other beneficiaries? Changes in income, obviously if income goes up, I have to do mandatory distributions next year, so I'm starting to do things like this. Let's spend some money in the business, and I'll just live off my RMDs and Social Security and rental incomes. If I don't need this as much, we can expand and build the practice. I'll still own all of the stock until I own less, and just do it for fun. But before it was, have to watch every nickel so we can spend a little bit more money. And you can start donating money out of your IRAs, right? And if you have a giant IRA and probably 401k, if you want to shrink it a little bit, you can donate money to charity out of that, and it'll bring it down and thus reducing future required minimum distributions. Or you could take some money out and put it in donor advised funds. There's a mutual fund out there, I think Fidelity has them, where you can put money in a fund a little bit each month. And that's your future donation that you're going to make to some charity. And let it build up. And if you don't want to donate all the money, I think you get deductions as you contribute to it, a tax deduction. But you don't have to donate that money yet. You could let it build over several years if you want. Or go to the charity and say, well, I might donate it to you, so you better be nice to me, right? So those are some of the important things. change in objectives, obviously, and the needs more income. Some people do. And when you do start taking more income out of a portfolio, we'll get the call, like this gentleman that I saw yesterday or other people. It's hard to accept as I see people get older and I get older, but it's been 45 years. So now some people really need that money. And so we set up an automatic draft to go from their brokerage account, whether it's an IRA or not. If it's an IRA, whether we pay taxes on it or not, that's up to the client. But it goes, we take money out of there and it goes to your bank, right? It's an electronic funds transfer. And if you do that, we need to say, if we're pulling out of this retirement plan or we need more money, if the market is down, we don't want to sell the stock portions, right? So we use the cash and the bonds. But if we have to sell stocks, we will have been better off to reallocate and start toning it down as the client starts taking money. So with the client I saw yesterday, if he starts needing big numbers of money, I need to start toning down the portfolio and make it more stable. So as we're pulling money out, if the market drops and the stock portions fall, the whole portfolio is not hurt too bad. If we have 100% stocks and the market's down 30%, you won't be down 30 because let's say you have stocks that are different than the S&P, but you might still be down 25 or something. But if you're getting to the point where, wow, I might need this money for income or care or kids' education, then I need to start reducing that allocation and introducing short-term bonds or preferred stocks or blue chip stock funds that don't tend to be quite as volatile. Maybe I'll buy a fund that specializes in the S&P, but it gets rid of the highest risk stocks, and we start preparing for a storm or the need to pull the money out over time. Because in 2020, remember the pandemic, what tax exclusion did the government make? Trick question. The RMDs, they waived those for a year, remember? If you had required minimum distributions in 2020, meaning you were 70 years old then, now it's 73, you had to pull money out each year based on the prior December's value. You had to pull money out each year, and that's part of your required minimum distribution. But because the stock market was down 38%, the government said, yikes, people might have to sell stocks that are down 38% or more, and they're going to have to sell twice as many. So they waived the required minimum distribution for that year, and you didn't have to do them. You could if you wanted to, and you had to do 2 of them the next year, but you had that option. Now, if we had planned properly, we had short-term, intermediate, long-term horizons. The short-term wasn't affected. I don't think the bonds were affected at all. So the stock portions were down more, so we would have had plenty of runway at that point. But people that might not have, or if they had all their money in a company stock, the government waived it for a year and gave you that option. So we want to keep doing your budget, keep doing your insurance and taxes and estate planning every year, and then look at the investment funds that are in the portfolio, and then is the portfolio done properly? It's like you're making something. Are the components correct, and is the overall thing? Any questions? I could keep you here a long time because I have a backup. Examples of accounts. You'll have accounts as individually owned. Problem with that is if you die, there could be probate. This is registration of accounts. You can have transfer upon death on an account. You can do that on real estate if you need to. If it ends up that a single individual owns real estate, you can do a transfer upon death, so you don't have to do a trust. If you're married, you can have joint tenancy or community property. That's fine. Or have a trust. That's good. So that's the joint tenancy. We don't prefer joint tenancy because you lose some tax benefits. There's a couple different types of joint tenancies. Per stirps is a legal term to make sure money goes to family members of a beneficiary or a joint person that died. Community property, if you own an asset that goes up a lot in value, if it's owned in community property and one partner dies, then you get to waive all the capital gains tax on that. And then tenants in common, that's more like, let's say a big house on, you look up, I want to see what prices are in Tahoe. Oh, wow, that's only $200,000. Oh, wait, that's tenants in common. That's like 0.1%. So tenants in common is a partnership. Special needs trust, we know what that is. We also want to monitor and manage the account security. So make sure that you've got everything covered. Fraudulent transfers, we want to be aware of that. We have to train in it every day. You guys are in business, you train in it. You know, you don't open up any emails or anything. I get more trouble by not opening up things that I'm supposed to. My insurance agent was mad at me because I didn't open up the thing to sign for the new policy. But it came under a new company's name. How am I supposed to know what that is? So yeah, I'm just going to sign everything, right? So whatever it is, but also if this stuff is redundant and easy for you, pass this on to other people. Pass it on to older people that can be taken by these frauds. Have their house inspected. Make sure they don't click on emails. FBI agents are never going to ask you to take money out of your account, right? We see that a lot. Go to the bank, get the money. They're so trained at this. They call the client. The client opens up an email, flash. Oh, you've been corrupted. Oh no, you need to turn your computer over to us. They do that. Then they find out how much money they have in the bank. Okay, now you need to go to the bank and empty your accounts because the bank's in on it, right? Well, in the old days, the bank would give them cash. The bank can't do that anymore. If it's over $10,000, and if it's suspicious, they won't give you anything. So the client goes to the bank, brings and asks for the cash. They don't give it to them. They go out and they take their check to the coin store and they write a check and they buy a bunch of gold coins. Now, you can't really trace gold coins that I know of. And so they meet the FBI agent out behind the McDonald's, give him the gold coins. He'll hold them for security, and then he'll give her a receipt. That's the kind of stuff you guys need to watch out for with the older generations other than us. And then the younger generation, all the insurances that we really need to have. And the biggest thing is when young people go get their job and I'm working for a big company, the first thing I want them to do is up the auto and the uninsured motorists, if they have, a spouse, life insurance, disability insurance, all the insurances they can afford to do. Because when we do a list of what are the priorities of things, cash reserve first so you can pay the insurance premiums, then all the insurances that you need so you can take more risk. And then from there, you can have a cash reserve to buy a house for the young people in that ladder that we showed. And then you can put money in the 401k. First year, I would tell the young people, put the money in the 401k, mostly, unless you have a lot of other backups, mostly stable investments in case you got laid off or disabled the first year. Then after that, it's 100% S&P and small stocks and all that stuff, very aggressive stuff. So you'll see in the book and you'll see in the class, what we did is try to lay out a process that covers the diagnostics first. All these things that we just talked about, just review those and make sure they're covered. Kind of like a doctor doing a physical before you get a medication. Then when you look at the last part of the diagnostics, the investments, at least have an awareness of, I need to make sure they're not the super high priced or inappropriately managed or really bad funds. Google all your funds if you want, and somebody will tell you whether they think it's good or bad. And you might get to Morningstar that way. But at least if you own mutual funds, make sure that they have a good history and a good credit rating. Not credit rating, but a star rating, 5 stars, 3 stars, or whatnot, and they have a low expense ratio. Okay, go ahead. So we look forward to seeing you in the class. Yeah. So do your homework on you. That's about all we need to do. Check the website out, come to the class and have fun.